All right, good morning, everyone. It is the 30th of March, 2021 at 8:53 in the morning, and this is my morning strategy session. So, first up, actually, the first stock on watch that I have isn't my favorite. And the reason that it's not my favorite is because you can see here on the daily this VIPS, VIP Shop Holdings, took a huge haircut. And the news is back here on the 24th. Let's see, I've forgotten what it is. On the 25th. Reports unaudited fourth quarter and full year 2020 financial results. I don't know what the results are. I haven't looked at it. It doesn't matter for trading purposes. But what does matter is what I'm seeing here in front of me. And we've got from peak to trough, we have a 45.7% sell-off. If it were to open right now, it would be roughly a 35% sell-off from its high. So Fibonacci's work really well in scenarios where there are big run-ups in consolidation or big drops in the consolidation. What I'm looking for today, I have an entry level at $30.24, and so what I'm looking for today is it's really close. Its current price, its pre-market price, is really close to that 30.24. We'll see what happens. What I'm looking for is for the stock to run up over that 30.24, come back, retest, and then continue higher. And I'm looking for a 1% gain. That's it. I probably won't take much risk on this one, like 200 shares. Next up is McCormick. Now, McCormick, this is interesting. McCormick is somewhat viewed as like a utility or a staple, consumer staple. Spices sell, whether the economy is good or bad. McCormick is a safe place to put your money. If you put your money, if you're looking at a long-term investment, which most people who buy McCormick, are, you can put your money there, and suppose we go into a depression. McCormick is going to be there on the other side of the depression. McCormick Spices, it's just a behemoth cash cow. So they had a good reporting on earnings. As you can see here, it's gotten it's up 4.39% from yesterday's close. I expect that there will be some selling on McCormick. There will be some profit taking on McCormick. I don't think there's going to be that much, though. Usually people who buy McCormick, are going to sit in it forever. They're like, yeah, I'm going to hand this down to my grandkids, kind of thing. So I don't know. I put the Fibonacci basically from the top of the pre-market price this morning to its close, and so that gives me an entry at 93.15. Yeah, I'm using the top three Fibonacci's. This is the 75%, which actually it's not 75%, so it's not technically a Fibonacci, but I changed it from whatever the 70-some percent Fibonacci is. I changed it to 75. This is the 61.8, and then this is the 50. The 50 is at 92.15. The 61.8 is at 92.62. If it gives me an entry in here, I'm going to go heavy on this one. I'll probably average into somewhere around 1,000 shares in between these three numbers. Yeah, it's on watch. I wouldn't be surprised to see this thing just take off and keep going. You know, if there's going to be some profit taking, there probably won't be that much profit taking. There's probably just going to be a whole lot of people who look at their portfolios today or maybe a week from now or whenever it is and go, oh, wow, look, McCormick's back up again. All right, this is cool. And you can see actually here in recent history here, this thing was up at 104. During the dip, it went down to 60, as low as $56 a share. So, I mean, look at this thing from bottom left to top right. You know, this is back in 2012. Let's go to the weekly. I mean, wow, back here in 1985, it was selling for $1 a share. You know, I mean, that is, you know, on a weekly basis from, you know, way back. I mean, that is looking kind of parabolic. I don't have it on a logarithmic. Let's look at the log. Look at that. It's just beautiful, beautiful chart. There's nothing wrong with this chart. You know, on the linear chart here, you can see it does look like it's going kind of parabolic, but you know, it doesn't really mean anything when it comes to sort of adjusted returns for inflation and so on and so on. So, yeah, I think it's okay to be pretty bullish McCormick today. And I hope it gives me an entry at one of my price levels. So then let's see, let's take that off of the weekly and put it back on the daily. And then the momentum play here, we have VTSI. VTSI is a small cap defense technology. They reported earnings and they did quite well. Their revenues and earnings are up. They do non-lethal training. They're let's see. Vertra Incorporated is a global provider of judgmental use of force training simulators, firearms training simulators, and driving simulators for law enforcement, military, educational, commercial markets. It uses, I'm former military, and actually I think I've probably used either, the company was founded by Robert D. Ferris in May 1993 and headquartered in Tempe, Arizona. So I've done the virtual trainings before, and they're pretty neat. You know, I don't know if I've used this guy's equipment. I don't know if I've used Vertra's equipment or not. But I know what it is, you know, and I can see why, you know, there's value in the training. And what this stock does today, well, it's a momentum play. I have 585 marked off, and I put an alarm on it. 585 is just a peak price from back here in February of 2021. That it's just a guide. It's not anything, you know, I'm not going to use it as an entry. It's just sort of there to see what price action is doing. So those are the ideas today. Yeah, otherwise I'm just trading this on momentum. I'll be watching the 1 minute for entries on VTSI. So let's see what else is going on. Okay, so we've got the SPY here, and more important than the SPY really is the VIX. The VIX just took a nice little tumble here. Let me open this up. So the VIX has gotten lower into the gap recently. This gap represents the gap from late February of 2020 into March of 2020 when the big downturn started to occur. And you can see ever since that it occurred, here it is right here, here's that gap right there. The VIX has gone back into the gap a few times, and it got into the gap here and went up and kind of stayed high for a bit. Got into the gap here, went back up, came down to the top end of the gap, you know, quite a bit, testing it, got into the gap, went back up, and now here we are significantly in the gap. And what I'd really like to see is that the tests these tests of the top end of the gap right here. Right, here's one. Yeah, I did a crappy job. Here we go. I'll just mark it this way. 1, 2, 3, 4 tests of this 22 level in the past, I'll call it 2 weeks of testing this 22 level on the VIX to get back up above the gap. What I'd really like to see it do is continue underneath of the gap and drop into the below sub 18.2, and things will get very bullish on the market. There will be a lot of equities moving in the northern direction if we break below and hold below 18.2. So the VIX is under pressure here, and there's no telling exactly what's going to happen. It could stay range bound for a while. It's something to watch, so you have a gauge of what's going to happen. As of right now, if the S&P opened right this moment, it would open up negative 0.05%, so essentially flat from yesterday's close. Then the next thing to kind of watch here, we've got the 10-year up at 175. Let's see, it's high here. Let's see, 173. So if the 10-year opened up right this moment, then it would open up at a new recent high, not new all-time high, but at a new recent high on this recent leg up. And so there's going to be some adjustment time for a new rate environment, a changing rate environment. Now, if this thing, I don't care if it goes up or down or whatever. I only care about its rate of change. So you can see it accelerated, quite a bit here, and it's not a bad thing. It's not really that bad for equities. It's just that there's going to be some adjustments to portfolios. There's going to be adjustments to allocation of capital according to various forces in the market, and the 10-year rates are a significant force. So what happens when rates go up? Well, those high yield dividend stocks, or any stock that pays a dividend, it gets revalued. I think that there are a lot of stocks that are still paying dividends that beat the 10-year. It's just that the relative, what's considered the 10-year is supposed to be the safest, the most risk-free trade you can make. You can buy the 10-year, you can get this whatever yield it's giving at the moment, and it's guaranteed. Whereas a company like, say, for example, McCormick, it has its dividend, and as much as a behemoth, and actually, I trust corporate America in most respects to be more reliable than the U.S. government. That's my opinion. But in any case, the relative yield on the 10-year versus these dividend-paying stocks or interest-paying stocks, there's going to be an adjustment in portfolios accordingly. Is it worth keeping an eye on? Well, yeah. If the thing just shoots up to 2, then there's going to be a lot of people freaking out about. And there's nothing to freak out about. But there are going to be a lot of people who are like, oh my God, I've got to adjust my risk or whatever. Wall Street likes to, run around like chickens with their heads cut off at anything. Anything to create movement in the market is an opportunity for Wall Street, and so any excuse they can get, they take. Let's take a look back here at VIPS. It just broke its level. And it's coming back up to that 30.24. Let's get rid of those paint marks I just put on. So, yeah, 30.24. If it opens above 30.24, that's not a bad thing. That might actually be an opportunity to just buy the open and take a percentage. Okay, everyone, that is my morning strategy session. Good luck out there today. Keep your risk tight. I will see you at the recap. And click like, share, subscribe, leave a comment, and see you at the recap. All right, out.